Ondas stock just had a really good day. The company may have made one of its smartest acquisitions yet, and traders are quietly piling into Ondas right now. Call contracts are outpacing puts, and the surge in implied volatility suggests investors are bracing for a sizable move. At the same time, a respected investing group just reiterated their strong buy rating while also discussing some serious risks. In today's video, I will be looking at all of this. Before we get into it, if you appreciate these videos, then help the channel by leaving a comment and hitting the thumbs up. I really can't stress how important this is for a small channel like mine since YouTube's latest updates. Now let's get straight into it. Last week, Ondas entered a definitive agreement to acquire Aran Defense Limited. This is an established Israeli engineering and manufacturing company. The acquisition is expected to add multidisciplinary defense engineering manufacturing operations to support local growing demand for Ondas's autonomous platform solutions. The acquisition is expected to significantly expand Ondas's local manufacturing and industrialization capacity in Israel. Aran operates approximately 4,400 square meters of facilities in Israel across its 3 facilities. These will expand Ondas's footprint with an established, sovereign Israeli industrial base that can be leveraged to increase production capacity as demand grows across its defense and autonomous systems portfolio. But here's the important part. As Ondas continues to report expanding order activity and backlog across its businesses, the company believes increased internal access to engineering, prototyping, integration, and scalable production resources will become increasingly important. Aran is expected to help Ondas convert product innovation and growing customer demand into repeatable production while providing greater oversight of quality, cost, supply chain availability, and delivery schedules. Aran Defense generated approximately $17 million of revenue in 2025, compared with $12 million in 2024, and is expecting revenue of approximately $26 million in 2026 with positive adjusted EBITDA. Under the proposed transaction terms, Ondas will acquire the business for $33 million of cash or Ondas common stock, representing approximately 1.3 times expected 2026 revenue. Ondas expects to close the acquisition during Q3 2026. So basically, this means that Aran Defense will give Ondas the ability to build more products more efficiently. It should improve quality, lower costs, and make deliveries more reliable. While at the same time, this is a rapidly growing business, from $12 million to $26 million of revenue in just 24 months, with positive adjusted EBITDA. All in all, this looks like a very good acquisition for just $33 million. Now, this is a very good analysis, and this was published just yesterday. Ondas, the growth is real, but so is the risk. And this analyst does have a good history with Ondas calls, having first called the stock out at $8 last year, just before it ran to its $15 52-week high. Again, his last 2 calls, the stock initially dipped directly afterwards, but then rallied hard for a couple of weeks. And he writes that Ondas delivered record Q2 revenue, raised guidance, and demonstrated 85% organic growth, yet shares remain flat amid high short interest. The backlog surged to $757 million, with a 2-year pipeline exceeding $11 billion, validating its growth strategy and execution. On the flip side of this, there is significant warrant liability and dilution risk, while margins have declined, and there is a serious cash burn. Now, I talked about all of this in a bit of detail in my last video a couple of weeks ago, so check that out at the end of this video. There will be a link to this at the end for anyone who's interested in a deeper look at Ondas's financials. Anyways, this analyst, James Ford, has issued a strong buy rating, so let's take a look at the reasoning behind this. First of all, Ondas had a blowout quarter, yet there was little to no reaction. Revenue was up 67%. Management raised full-year guidance. They're expecting to exit 2026 with $1 billion annualized run rate, while the backlog grew roughly $4 billion up to $11 billion. But the number that actually matters is the 85% organic growth. while backlog also grew 33% sequentially on a purely organic basis, which essentially means that the system is working. Ondas buys a strong but capital-starved business, integrates it into its own organization, and the growth picks up. This is the sort of thing that we see all the time from major corporations. Whether it's Meta buying smaller companies like Moltbook in March 2026 or Assured Robot Intelligence in May for just a couple of $1 billion. Or in the past 24 hours, Nvidia agreed to acquire Hugging Face for $12 billion. Usually, this can be done by big corporations with very large capital reserves. And this is something that Ondas now has, and their strategy appears to be working. So why is the stock flat? And this is very important. There is a $1 billion warrant liability on its balance sheet. This makes up about 60% of total liabilities. Because the warrants are marked each quarter, a rising share price produces a paper loss and a falling share price produces a paper gain. Net loss for the quarter was $89.7 million, but that includes a $15 million non-cash gain from warrant accounting, $44.2 million of other income, and a $29.1 million tax benefit. Until the share overhang is resolved, good operating news keeps getting absorbed rather than capitalized. While the cost structure is also an issue, margins have also decreased, but this is something that management have addressed in the earnings report, and I spoke about this in the previous video, so I'm not going to talk about it again here. Now moving on to the valuation and risks, because let's be honest, this is what really matters. Is Ondas overvalued or undervalued, and what could go wrong? So there's a nice breakdown here. Ondas is now valued at approximately $5 billion, but at the time of writing only yesterday, Ondas's market cap was about $4.7 billion. Accounting for the $1 billion of post-acquisition net cash, we get an enterprise value of $3.6 billion. That's about 6.8 times the midpoint of 2026 guidance and roughly 3.6 times the $1 billion exit run rate management is targeting. For a business guiding for 30 to 40% organic growth in 2027 in a segment where defense budgets are expanding, this seems attractive. The caveat is that this calculation treats the warrant liability as a liability rather than future shares. If those warrants convert, cash comes in, the share count goes up, and the per share math changes in ways that's hard to estimate, and that's an uncertainty that investors are paying for right now. As for the risks, guidance right now is roughly 73% sequential growth at the midpoint. That is an enormous task for a company simultaneously integrating multiple acquisitions, energizing supply chains, and standing up new production. The backlog is also very concentrated. Precision Strike and ISR together are over $500 million of its $700 million in revenue. And mergers and acquisitions haven't stopped. Ondas has since moved on to Aran Defense, which we talked about already, for $33 million, reportedly around 1.3 times forward revenue. Cheap, yes, but every deal adds to the integration load and eventually to the financing question. Overall, Ondas has done exactly what it needed to do this quarter, and the organic growth numbers are very strong. But the overhang from the warrants and dilution risk keep the lid on the stock price for now. But this analyst maintains that Ondas is attractively valued and remains a strong buy. But what do you think? Drop a comment below. Remember that I'm not a financial advisor. This is not financial advice, so always do your own due diligence. But if you enjoyed this update, then don't forget to smash the thumbs up. And if you're interested in that financial analysis, then click the video that's appearing on screen right now. Thanks for watching, and I'll catch you in the